Thank you so much for coming to check out the Stash Cast, where we have interesting conversations with interesting people. The Stash Cast is brought to you by Needle. What if you could use data and analytics to predict which transactions were going to occur before anybody else? With Needle, you can. Come check it out at Needle, NEDL.us to learn more. All right, today we have Travis Albee with us today. Travis, thank you so much for joining us. How are you?
Absolutely, Stash.
So you and I met when I was just a pup, when I was first starting in commercial real estate.
Me
And
too.
yeah, we were both brand new at that time. Why don't you give the audience an overview of who you are and what you've been doing since then?
Absolutely. Yeah. So I'm a former investment sales advisor like you. I believe we both started before the Great Recession in Southern California.
Yeah.
And I mentioned that because that was definitely a big part of my entrance into the business and kind of relates to where we are now in the business. And yeah, I learned a lot from my father. So I guess you could say I'm a second generation guy in commercial real estate because brokerage was just part of my journey. But I started out as a tenant rep, and then I did landlord leasing. Then I did investment sales and had a formidable career there for a few years. And we had a big team, did big deals, started to go into syndications. And along the way, I had referred a product called cost segregation, given that investment real estate is really tax preferred. And this was arguably the biggest or most prevalent tax solution. And fast forward, pandemic happened. I was an office broker in Los Angeles, and for a number of reasons felt that it was time to go full-fledged tax consultant and move out to the suburbs with the family and start wearing a new hat.
Yeah. Well, that's awesome. So you started in tenant rep and then you moved over into landlord rep for the leasing side. How was that?
Yeah, that was quite an interesting journey there. I learned a lot representing the tenants, and you could call them almost the primary customer in real estate, right? Because they're renting the buildings, and got to understand their facilities needs from the perspective of a business owner, from the perspective of an employer, in somebody who, a lot of these people are high energy. Real estate is not their number one priority, but was very important for them. And yeah, so it actually was great for me because it allowed me to step into wearing the hat of expert, I think, a little sooner than I would have been able to do had I been on the landlord side. And so it was a great way to get my feet wet. And then moving on to the landlord side of leasing, I was able to really understand from their perspective why they were tough to negotiate with when I was representing the tenant, and what their pain points were and what their weak points were. So yeah, it was a pretty neat transition.
That's awesome. Yeah, I found myself that in operating my own deals, I feel like it has made me a better broker because you can truly speak the language of a property owner. Whereas if you are just on the outside looking in, you're faking it or guessing, or you've not walked in those shoes. And so I imagine that set of experience was really good for you.
Absolutely. I think I really underestimated the knowledge that I gained from that, at least at the beginning.
Yeah, I was too anxious in the beginning of my career to get going, but I wish in retrospect that I remember this one guy I used to work with. He started off in property management, and then he transitioned over into brokerage, and it was like he picked it up right away. And I was like, oh, that makes a ton of sense. You already know how deals work, you know how they operate, and you probably, I think he was third party property management is what he was doing. So he already had the host of prospective clients. I was like, in retrospect, that's genius, but I didn't have time for that story in my life.
Yeah. So you went straight into investment sales, huh? That
Did.
that was the primary part of my brokerage career.
Yeah. So you focused just on when you were doing it, you were just focusing on office and retail?
Yes, I was primarily an office broker. I would say about half of my sales were owner user properties.
Okay.
And then the other half was a mix of investment office, multi-tenant investment office, and I would say the triple nets, sometimes multi-tenant retail, a lot of times triple nets that we were exchanging our clients into.
Okay. Nice. So then you did that for, I assume, a number of years. That's not an easy thing to just pick up.
Yeah,
Like,
that was like 8 years.
okay.
It was me, my father, and a real estate attorney that we partnered with. And yeah, we had some formidable years doing office brokerage in the San Fernando Valley, North Los Angeles.
That's awesome. It seems like a rich market for that, actually.
It was definitely a rich market, a very interesting market because there was this river that ran through my market called the 101 corridor, the Ventura Freeway. And you could be on one side of my market along the 101, and it felt like you were in the Midwest in terms of the demographic and the plight. And you moved down the 101, and you knew quickly that you were in Los Angeles, and it was a dog eat dog world swimming with sharks.
Yeah. Yeah. It's definitely a block to block sort of change of submarket, isn't it?
Absolutely. It was very interesting. But my whole real estate background, as you can tell, was very diverse in terms of the hats I wore, the people I dealt with and represented. And yeah, it was a neat experience.
Yeah. So you mentioned that you transitioned from investment sales during COVID into tax consultancy. What is that all about and what drew you to it?
Yes. What initially drew me to it was all the way back in the Great Recession when I started. My dad was an investment sales broker, and I was helping him not as a licensed agent on his team at SVN. And when investment sales halted in the Great Recession, we were really focused on marriage marketing and doing referral business to make some sustenance of cash flow and be able to cover the marketing expenses. So I started to learn about various products that our clients needed, call it products that didn't necessarily require a broker's license or an agent's license. And one of those products was cost segregation. And I quickly learned that, and it took me some time. Maybe I won't say quickly learned. I'll stick my foot in my mouth there. But I learned over time that it is, in my humble opinion, the best number two product for an investment sales advisor.
Okay. Why do you say that?
I say that because it really, in my opinion, is the tangible proof of being an advisor in this business. A lot of brokers, investment sales brokers, say they're an advisor, and you use SVN as a company you and I know well. And being a commercial real estate advisor is a big role in a name that they hang their hat on, and a lot of agents use that title. But what does that really mean? And I believe that means being more than just a commoditized broker. It means being able to advise not just on the sale and buy transaction, but how to own real estate, how to maximize your investment in real estate. And you learn from guys like Robert Kiyosaki, Grant Cardone, Robert Kiyosaki CPA, Tom Wheelwright, that investment real estate is very tax advantageous, and cost segregation is arguably the biggest aspect of that.
Yeah. So can you give us an overview of what cost segregation is?
Absolutely. So it's often referred to as accelerated depreciation.
Okay.
And I felt like I knew what depreciation was at the beginning of my career. And just as a refresher for our listeners, depreciation is an expense. It's an expense that we get with our real estate. It's really all it is, an expense. Say for commercial, you're writing off 1/39th of the building every year. And for residential, like multifamily, which you do, you're writing off 1/27 and a half, put my TH there at the end,
Mhm.
of the building every year. So those expenses are crucial for a real estate investor because they're making income, i.e., cash flow on their property. So we help them lower or eliminate their income taxes by accelerating, on average, 20 to 30% of their depreciation expense that otherwise would have been spread out straight line over 39 or 27 and a half years. We're moving that depreciation expense forward into faster schedules.
How are you able to do that?
We're able to do that because there is IRS regulations that allow us to do it. In fact, the IRS does not see a building as a building. They see a building as a basket of systems. You could say they look at the building as a much more detailed system as opposed to just one big building that's sitting there. In fact, a fun fact, when we do cost segregation on a building and the client's tax professional, the landlord's tax professional, does what's called a 3115 change of accounting form to change from straight line depreciation to accelerated depreciation, the IRS actually calls that switching to the correct method of depreciation.
So how did the incorrect method become such commonplace?
Yeah, so the incorrect method became such commonplace because it was the original method to do it, and because it's the easiest method, and
Hmm.
because the IRS usually gets more money with that method. So have they don't have a bite in saying it's the incorrect method, but they acknowledge that there's a better way.
Hmm. Can what is the correct method? Like how do you referred to a building as a basket of systems. What does that mean?
What that means is your building is made up of so many systems of from the HVAC as an
Yeah.
obvious system to the roof. You might not consider that a system, the carpet. Basically, um, what cost segregation is, it's doing an engineering study. A lot of the big cost segregation firms, most of them are engineering companies that are mapping out the components of the building, putting them into different depreciable buckets or schedules. Basically, any part of the property that is not land and any part of the building that is not directly related to the structure holding it up is considered a system. And that includes improvements on the land. That includes even landscape on
Hmm.
the property that can potentially be accelerated.
Wow. So you can you accelerate like if you're revamping the landscaping, you can accelerate the depreciation on that hardscape cost.
Definitely the hardscape, but I believe, and I will admit, I don't often get into the weeds of landscape, but no pun intended. But I believe trees as an example that you're adding to the property that you could depreciate those quicker.
That's amazing. So what are the things that you can depreciate a tree? Hilarious.
I'm pretty sure I'm pretty sure on that. We'll have to fact
We'll
check
double
that.
check. Yeah, asterisk that. So what are the things that are most common that you see as being able to speed up on depreciation to save your clients money on taxes?
Yeah, so we're talking about the parking lot, we're talking about the lights, the windows, the carpet, the HVAC, the roof, the tenant improvements, most of the tenant improvements.
Okay.
If it's a capital expenditure, which means that you're affecting the cost basis of the property, you're adding to the capital improvements of the property, then it's probably something you can accelerate because we're typically not adding to the structure of the property. But repairs and maintenance would normally be expensed by the client's tax professional. So that would be akin to having 100% bonus depreciation, would just be expensing the entire repair in the first year.
Oh, wow. So if you have, I don't know, a busted pipe or something or sewer line, you can expense that whole thing in the first year if you're going through the accelerated depreciation.
That depends. There are certain sewer items that might not fall into an accelerated category. And then when there are ones that could be accelerated, it comes down to how much of the system you're improving. If usually it's less than 30 to 40% would be considered repairs and maintenance, and over that would be considered a full capital expenditure, if you will. Therefore, is something you may very well could accelerate the depreciation on.
The way that I've understood accelerated depreciation is you look at, okay, the light switch has a useful life of 5 years. So you can take the cost of that switch and break it down over 5 years. And then after 5 years, you fully depreciated it. Is that the right way to think about things? As a for instance.
So typically, you're going to see that improvements are either going to fall into a 5 or 15 year category. Typically, site improvements are 15 years and interior improvements are 5 years. And it's there's also a 7 year category, but you don't typically see that improvements falling into that category. But you're going to it's more based on where it is in the category. And I won't say it's arbitrary, but I won't say it's highly correlated to the actual useful life of the improvement.
Okay.
There's just rules and regulations on it.
Are there any like rules of thumb that you live by, or like how do you figure it out?
That's honestly, I leave that to the engineers.
Okay.
I'm more of the consultant and the sales professional, and we have an analysis department. And so we do an initial free benefit estimate on a property for a client or for an advisor for their client. And the analysis team will look at the property and do a quick and dirty estimate of what that would be. And then later on, when the client moves forward on doing cost seg with us, that's when the engineers, the analysis team will really peel back the onion and look at each item.
Okay, that's interesting.
Yeah. Yeah, my role comes more into play on in advising in how to use these products, this product as an investor, as an advisor, and I'm consulting more on a holistic, more general strategy, tax strategy of how to use the product.
So what are some of the most successful ways that you advise your clients then on how to use cost seg?
Yes, I think that for most investors, it is an integral part of the investment real estate strategy in general. And the reason for that is, in essence, it's a time value of money play. What's happening is the client is making it a goal or budgeting to pay little to no income taxes every year. And by having that tax savings, they're able to reinvest that money to improve the property, to increase NOI, either by increasing rents through beautifying the property, let's say, or decreasing expenses by making energy improvements, let's say, to the property, increasing NOI, therefore increasing value to the property, and potentially getting more depreciation expense in the process. And another way to use it is to use it as the tax savings, I should say, is to use those as a down payment, say, on another property. And so that's the strategy. It's nice to save $70,000 in a year, but you can turn that $70,000 into $1 million over the life of the depreciation on the property.
Yeah, that's amazing. Have you seen clients take those savings and use them on down payments for other and just keep rolling it for other deals and just keep rolling it?
Absolutely, absolutely. Happens all the time. Oftentimes, cost segregation is how they finish up filling up their piggy bank to get ready to buy their next deal.
Man, that's genius. It's genius.
I think so.
Yeah. Do you have any good examples or stories of how you've seen people be able to take advantage of the services that you offer?
Absolutely. And I will say there's different sort of client examples where it makes sense in slightly different ways that they use it. And let's talk about a couple of those. One example would be the real estate professional. This might be a syndicator. This might be a property manager. This might be a commercial real estate broker slash syndicator.
Mm-hmm.
And one of my big clients is a property manager, and he's second generation and he does pretty well. He's got quite a bit of cash flow, quite a large income tax issue. And his piggy bank fills up with about $1 million a year from property management fees, about $1 million a year from syndication, from his cash flow that he's getting on his real estate. And I said to him, hey, you must be paying a lot of income taxes. I know you got depreciation, but are you still paying some income taxes? He said, yeah, I'm still paying on $500,000 to $600,000 of income a year. And I said, you should not be paying income taxes. You have so much depreciation sitting in all these properties that you own, because he has a large portfolio of properties that he owns either himself or with partners, or owns a piece of it with one of his clients. And I said, you just need to move up more depreciation and make your goal to pay little to no income taxes every year. And that's what he does now. And he's been doing that for quite a few years now. And I don't think this guy is going to be paying any more income taxes for the rest of his life. That's one guy.
Yeah.
So that's one example property owner. The other example owner is, say, an owner user. An owner user, they're not a real estate professional, but they're buying a property, and what they are allowed to do within the first year, I should say, on their first tax filing after purchasing the property, is they can group the building and their business together. And what that allows them to do is to use the depreciation expense. Remember, depreciation is an expense. to write off against their business income. So these owner users we know are cash flowing nicely. That's why they're buying a real estate. Another reason they're buying real estate sometimes is their tax professional might have said, hey, you've got an income tax problem. You ought to buy your building instead of leasing your building. That's why. And if it's an SBA buyer, they can recoup the majority, if not all of their down payment with that tax savings from cost segregation.
That's interesting. I have a friend who's an insurance broker I should introduce you to. He's looking at buying a building. He was actually the first guest. What are some of the common misconceptions of cost seg?
Yeah. So not so much anymore, but an original misconception was, oh gosh, this seems too good to be true. Is this legal? The IRS probably doesn't like this. And that was a question that got asked a few decades ago and still gets asked on occasion. But the reality is, if you're in the industry or if you just Google cost segregation, that it is so prevalent, so mainstream, although there still is so much opportunity for using it, for selling it, that people aren't taking advantage of, that investors aren't. So that's one. Another one is this going to come back and bite me? So we've learned about what's called depreciation recapture.
Right.
Okay. And so if you think about it, if you're moving up a lot of depreciation, in essence, your depreciation recapture could be worse when you sell a property. And basically what that is you're repaying, when you sell a building and you don't do a 1031, you're repaying depreciation that you took earlier on the property, and you're repaying it at ordinary income tax rates. And long story short on that, if you're going to hold the property for quite a while, then you're getting the time value of money benefit. Or if you're going to sell it in the near term, then you're going to want to know that you're going to be doing a 1031 exchange. And
Yeah.
little did I know that a 1031 is not just for deferring capital gains, but it's for deferring depreciation recapture as well.
Yeah, it's probably as much for deferring capital gains recapture, or I'm sorry, deferring recapture as
Depreciation
depreciation
recapture. Yeah.
as it is deferring capital gains. I think the headlines of 1031 go to capital gains, but it's
Yes.
to your point. Yeah. Interesting. Okay.
A lot of incentive to do a 1031
A lot of it. Yeah.
for your clients.
And we hear that a lot. If I sell it, I have to do a 1031. And I assume that's what they're talking about.
It is. And by the way, at A&A Tax Savvy Real Estate, which is my company, we also advise on 1031 alternatives.
Oh.
For that client that says, I'd love to sell, but my tax bill is going to be gigantic and I don't want to do a 1031 exchange. I'm not going to sell. And that's something we can help with as well.
What are some of those alternatives?
That's a secret. I can't tell you, Stash.
You'll have to call.
When it comes to alternatives I should say, deferring or avoiding taxes, there's not a one solution fits all sort of product or one product fits all solution. It really depends on the client's tax situation, on their plan, how big the property is, what kind of property it is. And I will say that is when you're getting a little bit more cowboy or cowgirl, when you're really being more entrepreneurial, when you've got some things to review heavily with your tax professional, which we would always do for cost seg as well. with potentially a real estate attorney as well. Some of these products are even on what's called the IRS's Dirty Dozen list, which is basically the IRS saying, these are the top items we don't like. One of those would be like a monetized installment sale or a business trust. A deferred sales trust would be another example of a monetized installment sale. And that doesn't mean there aren't people doing it. That doesn't mean it's not something that you should consider, but it's not necessarily something that is as straightforward as, say, cost segregation.
Interesting. How would real estate professionals like myself best be able to take advantage of cost seg and the services that you offer?
Yes, we're on LinkedIn. LinkedIn is a great way to review what we're all about, follow our content. My name is Travis Albee. That's A-L-B as in boy, two E's as in Edward, like Edward Albee, the playwright, or as my father says, we'll all be. So you can find me on there. You can find Albee and Associates. That's a great way. And we obviously pay referral fees. So that's something that's nice. But I won't say arguably, I will say absolutely the biggest benefit of our products is in business generation, is in providing solutions that help a broker close more deals. And I would say the third one there is adding value. It's even more important in this environment that we're in that you, for lack of a better term, justify your value as a broker, that you're not just a commodity in the market. And this is one of those things that is hugely valuable, that shows immediately that you are an advisor, not just a broker.
Yeah. Yeah. Like I said at the top, it's once you start to walk in those shoes, it definitely makes you a better professional at whatever it is that you're doing. Awesome.
Absolutely. It's such a big part of the game.
Yeah.
Can't stress it more.
Yeah. What else would you like to share? What's like what's the ideal kind of referral or prospect or client for you?
Our rule of thumb is, let's talk about any type of client, any type of situation. And then we generally say, let's do a free benefit estimate.
Yeah.
I've got a whole analysis team with the national firm that I'm a direct sales rep of, CSSI LLC. We're the most experienced cost segregation engineering firm in the country. So we have a whole experience analysis team that can take a look at it and see what the opportunity is there.
Awesome. That's great, Travis. Cool. What is the best way to get in touch with you?
The best way to get in touch with me, again, is LinkedIn. You can go to my website, albee-associates.com, and just give me a ring. I think it's my cell phone there on the website.
That's great. Awesome. Thank you so much. And I hope you have a great rest of your day.
Absolutely, Stash. Thanks for having me on.
All right.